Hello, and welcome to the first 2022 edition of Reflections on Investing with the Cornell Capital Group. And as the year started, I hope you had a chance to look at the Cornell Capital Group's fourth quarter memo, which came out at the turn of the year. It foresaw some of the things that we've experienced, including, most importantly, the decline in stock prices and the increase in volatility. But that's another issue. What I want to talk about today is a simple technique we use at the Cornell Capital Group for breaking down the total market capitalization, that is the value of the equity of a company, into three parts that allow you to kind of see the extent to which the value is based on speculation versus basic value. Here's how we go about it. Let me go to the iPad. The three components are as follows. The first is the book value. That can be thought of as the amount of money that investors have put into the company as of the current date. And that's observable right on the balance sheet. There's no guessing or speculating about the book value. The second is what we call the near-term forecast value. And here's how we calculate that. It's a little tricky. We begin with analyst forecasts for both the current year, we'll call that year one, and the year following, year two. We then take next year's forecast earnings, net of the cost of capital, and we discount that back to present value using a reasonable discount rate, usually about 6%. Then the second thing in the near-term forecast value is we take years two forecast earnings, net of the capital charge, and we assume that the company earns that into perpetuity. So it takes those year two earnings, which are reasonably certain. We're not guessing what's going to happen in a decade. It's just the analyst forecast 2 years out. We assume they earn that into perpetuity, and we discount that back to present value at the same rate. We add those two things together, and that gives us the near-term forecast value. Then the third thing, we call it the speculative value. And it's actually a residual. It's the difference between the current market capitalization of the company and the first two items, the book value and the near-term forecast value. It'll become clear how this works in a minute when we look at some examples. But those are the three parts: the book value, the near-term forecast value, and the speculative value. So to see it in action, let's look at some real companies. At the top of the list here is Rivian Automotive. You've probably all heard of this. It's the new startup that makes electric trucks, just went public in a big fanfare and was worth more than Ford Motor Company right out the gate before it sold a car. The book value per share of Rivian Automotive is $4.45. The near-term forecast value happens to be minus $6.53. That's because Rivian is forecast to lose money in the first couple of years. The market value is $73.16. So when you take the difference, the speculative value is $75.24. And you see that 102% of Rivian's market value is the speculative value. So that's a company that if you buy Rivian, or if you're betting on the future, the distant future, it's almost all speculative value. Here at the other end of the line is Delta Airlines. Delta has a book value of $5.71 per share, a near-term forecast value of $84.52, and a stock price of $39.54. So the speculative value is minus 50.7 or negative 128.22%. Delta is worth far more, Delta's solid book value and near-term forecast value is far greater than the stock price. In the middle, we'll pick a famous company. This will be my last one, Tesla. Tesla has a book value of $23.82, a near-term earnings forecast value of $121.96, and a market value of, as of this date, it's gone down since then, of $1,030. So Tesla has a speculative value, counts for 85% of its value. So what this breakdown allows you to do is see what you're buying and investing in. If you're buying companies like Rivian, Chewy, Carvana, Spotify, or Tesla, you're paying a lot for the speculative value. If you're buying Gilead, General Motors, Dell, AT&T, or Delta, all of those have significantly negative speculative values. You're counting on the company to be able to continue its current business. So at the Cornell Capital Group, we like to use this breakdown as a starting point. It doesn't tell you exactly what to buy, but it gives you some good hints. This has been Reflections on Investing.